A house flipper makes his money exactly once. He buys the wreck, fixes it, sells it, pockets the difference, and then he is right back where he started. An empty bank account, a fresh hunt for the next deal, the whole nerve-wracking machine needing to work all over again just to keep him fed. Now picture a different investor standing on the same ugly street, buying the same caved-in house, renovating it the exact same way, and then, at the precise moment the flipper would cash out and move on, this one does something that sounds like a mistake. He refuses to sell. He keeps the house. He keeps the tenant. He keeps the rent landing on the first of every month. And somehow, he still walks away with his money, all of it, back in his account, ready to spend again tomorrow. He got paid without selling the thing he got paid for. Do that once, and it's a curiosity. Do it 5 times in a row, and you own 5 houses that each pay you every month, built with money you technically never spent, as if the purchases were free. It has a name that sounds like a shiver, BRRRR, and for about a decade, it was the closest thing American real estate had to a cheat code. The thing that turned school teachers and nurses and guys with ordinary day jobs into owners of 10, 20, 30 rental properties. But the exact feature that makes it work is also the feature that can bury you. And both of them hide inside a single word that nobody says out loud while they're showing off the houses. Let's find that word. But first, the trick itself. Because it is real, it is genuinely beautiful, and you cannot see what it truly costs until you see precisely how it runs. BRRRR stands for 5 steps, and each letter is a stage in a loop. Buy, rehab, rent, refinance, repeat. The whole thing lives or dies on a single idea that most people never think about when they buy a home to live in. The idea that a property has 2 different prices at the same time. There's what it's worth broken and what it's worth fixed. The distance between those 2 numbers is where the entire strategy lives. A normal home buyer walks into a clean, updated, move-in ready house and pays full retail for it. The BRRRR investor does the opposite. They go looking for the house nobody wants. The one with the sagging roof and the kitchen from 1974 and the smell you notice before you're through the door. The one that's been sitting on the market for 90 days because every ordinary buyer took one look and walked away. That house is not a problem to the investor. That house is the entire opportunity. Because that house is cheap precisely because it's broken. And the investor is in the business of fixing broken things and capturing the difference. So step 1, you buy. Let's use real numbers because the numbers are where the magic hides. Say you find a house in a decent working-class neighborhood that, fully renovated, would sell for $150,000. That number, the value after it's fixed, has a name in this world. It's called the after-repair value, the ARV. And it is the North Star of every decision you're about to make. But right now, the house is not worth $150,000. Right now, it's a wreck, and you buy it for $80,000. Often you don't even use a normal mortgage to do this, because normal banks don't like lending on houses with holes in the floor. Instead, you use cash, or you use something called a hard money loan. Short-term, expensive money from a private lender who charges you 10, 12% interest and a few points on top, because he knows you'll pay him back fast. That money is not cheap and it's not meant to be. It's a bridge, and you're only standing on it for a few months. Step 2, you rehab. You put $30,000 into the house. New kitchen, new bathroom, new flooring, fresh paint, a roof that doesn't leak, systems that work. You are not decorating. You are manufacturing value. Every dollar you spend is a dollar aimed at closing the gap between what the house was worth broken and what it's worth fixed. This is the part the strategy shares with house flipping, and it's the part that requires actual skill. Knowing what to fix and what to leave. Knowing a good contractor from a thief. Knowing how to bring a project in on budget when every project in the history of construction has wanted to run over. Add it up. $80,000 to buy, $30,000 to fix. You're $110,000 into this house, and once you fold in closing costs and the interest you paid on that hard money and the taxes and insurance while the work was happening, call it $120,000 all in. $120,000 of your capital sitting inside a house that is now, finally, worth $150,000. Step 3, you rent. You find a tenant and they move in and they start paying you $1,400 a month. This step matters more than it looks, and not just for the income. The rent is what transforms the house in the eyes of the next player in this game, the bank. A flipper sells the house and walks away with the difference. The BRRRR investor does something stranger. They keep it. And a house with a paying tenant is not a renovation project anymore. It's an income-producing asset, and banks have entirely different, far friendlier rules for lending against an asset that pays for itself. Which brings us to the step where the boomerang comes back. Step 4, you refinance. This is the heart of the whole thing. The move that separates BRRRR from ordinary flipping and turns it into a machine. You go to a bank, a real bank now, or a lender that specializes in rental loans, and you say, "Appraise my house." And the appraiser walks through the beautiful renovated home you've built, looks at what similar renovated homes are selling for, and writes down a number. $150,000. Not what you paid, not what you spent, what it's worth now. And the bank looks at that number and offers you a new loan based on it. Not the full amount. Banks lend a percentage, usually around 75% of the value on a rental property, keeping a cushion for themselves. 75% of $150,000 is $112,500. That is the size of the new loan the bank will hand you. You use part of it to pay off the hard money lender who bridged your purchase, and the rest, the cash left over after that debt is cleared, is yours. It lands in your account as a check, and because it's borrowed money and not profit from a sale, you don't even pay tax on it. Do the arithmetic on what just happened. You put $120,000 of your own money into this house. The refinance just handed you back $112,500 of it. You have recovered almost every dollar you spent, and you still own the house. You still collect the $1,400 a month. Your money didn't disappear into the walls, it came home. And that is step 5. Repeat. Because your capital is back, or nearly all of it, you can take that same $112,000 and go find the next broken house. Buy, rehab, rent, refinance, and pull your money out again. And again. The same stack of dollars cycling through property after property, each cycle leaving behind a house you own free of your own trapped cash, each house throwing off rent, each one quietly appreciating while a tenant pays down the loan. This is why people call it a money recycling trick. In a normal investment, you spend $1 to buy an asset, and that dollar is now locked inside the asset until you sell. You can do it once. With BRRRR, done right, you spend the dollar, you get the dollar back, and you keep the asset. The dollar becomes reusable. And if you can reuse the same dollar an unlimited number of times, then in theory there is no ceiling on how many houses one modest pile of money can buy. Investors have a term for the return on a deal where you pull all your money back out. They call it an infinite return, because you divide your profit by the cash you left in the deal. And when the cash you left in the deal is 0, the math breaks. The calculator just shows infinity. It's an intoxicating word, and it's printed on 1,000 courses and seminars and YouTube thumbnails, and it is technically mathematically true, which is exactly why we need to slow down and find the word nobody says. Here's the word: debt. Every single dollar that came boomeranging back to you in that refinance was borrowed. It wasn't profit. It wasn't the market rewarding your genius. It was a loan, secured against the house that you now have to pay back with interest for the next 30 years. The reason it feels like free money is that it arrives as a lump sum and it isn't taxed, so your brain files it next to a paycheck or a windfall. But it is the opposite of a windfall. A windfall is money that comes to you. This is money you now owe. What BRRRR actually recycles is not your cash, it's leverage. Every time you run the loop, you don't just acquire another house, you acquire another large debt. And you thin out the cushion of equity that stands between you and disaster. The very thing that makes the strategy feel magical, pulling out every last dollar, is the thing that leaves you owning a portfolio with almost no margin for error. You have manufactured maximum ownership and maximum fragility in the same motion. And they are the same motion. Now watch what happens when the world moves, because the world always moves. The entire trick depends on that appraisal coming in high enough. 75% of 150,000 is what let you pull your money out. But an appraiser is not obligated to agree with you. If the appraisal comes back at 130 instead of 150, 75% of that is 97,500, and suddenly you're leaving more than $20,000 of your own money trapped in the deal. The boomerang lands short, you can't fully reload, and the repeat step stalls. And appraisals are the small risk. The large one is the price of the borrowed money itself. The whole machine was built and popularized during a very specific decade. A decade when interest rates were scraping along near historic lows, when you could refinance a rental into a 30-year loan at 4% or less, and the rent comfortably covered that cheap payment with room to spare. In that world, BRRRR wasn't just possible, it was almost easy. Then rates changed. When mortgage rates climbed from around 3% to over 7% in the span of a year, the math didn't just get worse. For a lot of investors, it inverted. That same $112,000 loan that cost around $500 a month in principal and interest at 3% costs roughly $750 at 7.5%. Add the property taxes and the insurance premiums in many markets jump double digits in a single year. And the $1,400 rent that used to leave you comfortable now barely covers the bill, or doesn't cover it at all. The refinance that was supposed to free you now chains you to a payment the rent can't feed. And you're covering the shortfall out of your own pocket every month on a house you were told would pay you. Overnight, a strategy that minted landlords went quiet because the cheap money it was standing on had walked away. So who actually wins here? Reliably in every version of this story, whether rates are low or high, whether the appraisal comes in or falls short. Follow the fees and you'll find them, the same way you find the real owner of any business. Not by looking at who does the work, but by looking at who gets paid no matter what. The hard money lender got his 10% and his points on the way in a few months, whether your rehab succeeded or blew up. The bank that did the refinance earns interest on that loan for 3 decades, and it lent you only 75% of the value while holding the whole house as collateral, meaning if you ever fail to pay, it takes an asset worth far more than what it's owed. The appraiser got paid to write a number, the contractor got paid to swing the hammer, the title company, the insurance company, the property manager if you use one, every one of them extracts a certain contractual cut, up front, indifferent to whether you personally come out ahead. You, the investor, the one who found the deal and took the risk and signed personally on the debt, are the only participant in the entire chain whose reward is not guaranteed. You are holding the leverage, and leverage is a lever that lifts in good times and crushes in bad ones. The lender recycles money at almost no risk. You recycle risk and call it recycling money. And yet, and this matters because it would be too easy to end on the cynical note, people do build real, durable wealth with this strategy. Not the ones chasing the infinite return thumbnail, but the ones who quietly break their own machine on purpose. Meet the disciplined version of this investor. Not a specific person, an archetype. The one who actually still owns a portfolio 10 years after the seminar crowd went silent. This person does not pull every last dollar out on the refinance, even though they could, even though the math tempts them every single time. They leave equity in the house on purpose, 20, 30%, so that when an appraisal disappoints or a market dips, they aren't underwater, and they aren't feeding a property from their own paycheck. They buy the deal so far below its after-repair value that even a conservative appraisal returns most of their capital, which means they never depend on the numbers being generous. They stress test the rent against a payment 2 or 3 points higher than today's rate, so a change in the world is an inconvenience instead of a catastrophe. They understand the thing the marketing hides, that the point was never to own the most houses with the least money in the shortest time. The point was to acquire assets that pay for themselves and appreciate while a tenant retires the debt, and to still be standing when the cycle turns, because in real estate, The person who survives the downturn buys the wreckage from the person who didn't. One house pulled apart for maximum leverage is a bet. 10 houses built with a margin of safety is a business. So the trick is real. That has to be said clearly because it's true. You genuinely can buy a house, force its value up with your own labor and judgment, borrow against that new value, recover most of your capital, keep the asset, and do it again. The money really does come back. But it comes back wearing a mask, and the mask is the word profit, and underneath the mask is the word debt. BRRRR doesn't repeal the oldest law of investing, that return and risk are the same substance measured from two directions. It just moves the risk somewhere you're not looking, into the leverage you can't see because it feels like a refund. The infinite return is real, and so is the infinite exposure sitting right behind it. And the only question that actually determines your fate is whether you built the loop to survive the day the cheap money leaves the room. Because it always leaves the room. The recycling trick was never really about recycling your money. It was about how much of someone else's money you were willing to stand on top of, and whether you remembered, while everyone was celebrating the boomerang, that a boomerang is a thing that comes back around, and that what comes back around depends entirely on how you threw it.